Gonzalo Cañete, let's see if we have it here already. Here we have it, ATFX Connect. Gonzalo, how are you?
Hello, Martha. How are you? Good afternoon. How are you?
Well, this is a data that the market is taking very positively, although we always say it here, don't we? Every tenth counts, and the fact that unemployment is only up 0.1% from 3.8 to 3.9, the market has taken it very well, but there is more data. Of course, there are the three, right? Unemployment is rising, the creation of non-agricultural jobs, which is a little lower, already below 200,000, which I do not know how important this number is, whether we should be very concerned about the fact that it is already below 200,000 or not. And then there is the issue of salaries, right? Here we see how they continue to rise, but less than expected and less than the previous figure.
Yes, wages are losing power. Unemployment rate rises very slightly, 3.9. It should not be forgotten that it also rebounded in November 2023. That is a few months ago, and fell again in the following period to 3.8. Therefore, these are data that do not have or lack relevance at the macroeconomic level because there are very few differences, but they are useful for the headline, which is the unemployment rate increases in the United States, the average hourly income also fell or grew less than expected, and so on. But you have made several interesting points. I agree with you 100% on what you were saying, even though the other colleague told you that there was no relation between this, but I think it is textbook. You were saying precisely that an increase in the unemployment rate, these data that are coming out, which show some weakness in the labor market, should encourage the market, which is what is happening, because in principle, it would be more arguments for the Federal Reserve to be more flexible in its monetary policy. And there is a key argument. Why would this be working? Why would this be what the Federal Reserve really expects? Well, I'm going to share a screen with you to see if we can analyze this quickly, but concrete. Okay, as if it were a class, almost. Yes, I don't know if you see it. As soon as you see it, let me know and I'll tell you.
We can't see for the moment, Gonzalo. I don't know if you hear me.
Yes, I'm listening.
Okay, I think it's working now.
So basically, what we are seeing is that this is, since the 50s, what the central bank, the Federal Reserve, in this case, uses to argue all its paraphernalia. So what you're saying is, if the inflation rate remains elevated, the unemployment rate should go down. That relationship that makes them tell us, for example, that the inflation rate, as inflation rises, the unemployment rate rises, the unemployment rate decreases, is what is not fulfilled. And so we are told that if the unemployment rate is rising, inflation should be falling. It's just the opposite. They are inversely correlated. So what we expected, and this is what the Federal Reserve argues, just so you see the example, we continue to see this. Here we have the inflation rate that was back in 2015. It was less than 2%, less than 2%. Inflation rate was at 1.6, 1.7, if I'm not mistaken. And that has been the normal until practically the inflation that came in 2022. Here we have the unemployment rate above 6%. So something is broken, and that's why the Federal Reserve, without worrying, knows it. According to the economic textbooks, rises in the unemployment rate should contain inflation, and so the variables have been. What worries them is that inflation is still at 3.2. We said here that inflation was not falling. We repeated it more than once because since June 2023, inflation has not decreased. It went, the maximum it fell was to 3.2, if I'm not mistaken, in June. And since then, what we have seen is that it has continued to go up. Since then, it's moved more of a zigzag. And that's what was generally creating this problem for us. Notice 3.5 in March. The most it dropped was 3% in June 2023. Since then, it's zigzagged, and that's what the Federal Reserve is thrown off by. A rise in the inflation rate would mean they are in trouble and can't cut rates. But an increase in the unemployment rate, according to the Phillips curve we were talking about, would mean that if unemployment increases, inflation is going to decrease, and therefore they can cut rates. In conclusion, following the economics textbooks, the upturns in the unemployment rate should push the Federal Reserve to start easing monetary policy. And that is why Wall Street is now encouraged by this data. I mean, I agree with you, Marta, in a nutshell.
Do you think that if Powell were to come out today and speak as he did last Wednesday, would his speech change? Would it change anything? At the end of the day, we are talking about 1/10, as I was saying, in the unemployment rate. It is true that there are many thousands in the creation of maritime novenas, but is it enough to change Powell's tone? No.
No, it is not. It's not, and I'll tell you why, because basically keep in mind that we have seen that his tone has not changed, even though the data was bad. I mean, when the data that we have been seeing did not fit the discourse, did the Fed's discourse change, or did the Fed continue to insist on, no, we are willing to, for example, the rate cut was proposed in December. Since December, the unemployment rate has improved, i.e., one less argument in favor of the rate cut the inflation rate picked up, and they kept insisting that there would be rate cuts and that they were committed to this and that and so on and so forth. In other words, they are not going to change their discourse because a piece of data like this comes out like this, because they are not going to trust it. Cascares also said it in December. When a negative employment report came out in November, like this one, like today's, Cascares simply said not to get too excited about the market because that was an employment report. Maybe the next month's report would change, and indeed the next month's report improved on the previous one. Therefore, they are not going to change the data for the market to discount what the trend generates. There has to be movements, there has to be volatility, there has to be money moving in the market. And with this data, money starts to encourage equities to fall a little bit. Just look at the bond correction. It has been beautiful because this bond, which we have used so much in the videos of Negocios TV, look at how it is, starts to make the wick just when it recovers that fall with the data. That is to say, the data could have taken us towards the 5 or 25% yield of the 2-year bond, but it has taken it to 4 or 25%, which is precisely the zone that it was having trouble crossing every time the Federal Reserve said that if they were going to cut rates, they were going to cut them down. Now that the bad employment data comes out and the yield of the 2-year bond moves us once again to what was a former resistance and is now a support, which is the 4 or 25% yield rate.
Well, indeed, bond yields down, futures up as well. Gonzalo Cañete from ATFX Connect, thanks as always. My pleasure.
A pleasure, thanks to you.
Well, and let's take a quick look also at how the market is pricing.